Careful of safe investments. I'm going to share with you a story about how a safe investment destroyed people and how I can see it starting to come back around with the yield still staying low out there, and people are what's called reaching for yield, wanting to get more bang for their buck on their safe money. Stay tuned, because this is going to be an example of not shenanigans, but stuff you've got to be careful of when it comes to your hard-earned retirement money. So thanks for coming to Heritage Wealth Planning YouTube channel, my friends. Don't forget to subscribe. As always, I got to do that side. It's changed now. I changed the camera, so I got to do that side. Subscribe down below and then hit the bell to be notified for future content, because we're doing a couple videos a day. All right. So let me share you with a story of what's going on. I have a client up in Tennessee, wonderful guy, and he got a bunch of money in a savings account, a high yield savings account, paying like 1.5 or something like that. And they're pretty conservative. They have more than enough Social Security and pension to cover their bills. They're in good shape. So they don't need to take any risk with their funds. Now, they do have a little bit of equity, it's not much, but by and large, they're just like, hey, we're here and we're just going to hang tight, and we're going to keep a couple $100,000 in cash. There's nothing wrong with that, at least. It makes them feel better about it. And hey, I'm all for that for sure, as long as they have enough income to cover their expenses, and they certainly do. It's just not close. So the guy at the bank, at the Bank of America, recommended them to talk to their bank broker from Merrill Lynch, and I got no problem with that. I was never a bank broker, but a long, long time ago, I was a bank platform guy, and a bank broker, a guy named George, when I used to work at First Union Bank. This is in 2000 and 2001. George Rand was a big influence on me in terms of telling me to kick me in the pants and told me to stay on with my CFP course, Certified Financial Planner. So I got no problem with a bank broker, none the least. The issue, I'll tell you where I had the problem was, is when these bankers, they have money in CDs and safe, in this case, high yielding money market account, which was FDIC insured, and the bank broker is looking to make a sale on what should be safe money. And that bothers me, because the bank broker, in this case from Merrill Lynch, was saying, hey, you're only getting 1.5, whatever it is. We can get about 3% more. Not 3% more, but 3%. So basically double your yield. And that's a good sales pitch. I'm not going to lie. Well, you can double my yield for just a little bit more risk. I'm interested in that. And so, anyway, so long story short, my client got the stuff from Morningstar about how the funds, and it wasn't this fund that you see here, it was similar funds. And he said, what do you think, Josh? And I, having been around the block more times than I like to admit, I said, nope, not doing it. And for a couple of reasons. So they're using these things called floating rate funds, all right, floating rate funds. And I'm not going to go into the mechanics of what a floating rate fund is, but just let me share something with you. Floating rate funds are short-term bonds that pay a little bit more yield. So right here we got 4.19% is a 30-day SEC yield. Now it's short-term, all right. So that means there's not what's called a high duration. I don't even know if it has a duration on here. So let me explain what duration is. Duration 0.51 right there. All right, so a couple things jump out at me. You have a 30-day yield, 4.19, and a low duration, 0.51. So that means for every 1%, what duration means, for every 1% increase in interest rates, the price per the bonds in the fund will drop, in this case, by 0.51. All right, so a lot of bond investors, fixed income investors, are concerned about an increasing interest rate environment, because that will have a negative impact on the price of the bonds that they have. I've already explained with you in other YouTube channels, you shouldn't let that worry you for a number of reasons, which we won't get into here. But if that is a concern, then the number one issue is the duration, not the maturity. The duration is the mathematical way we can determine the price drop for every 1% increase in interest rates. Does that make sense? So if you have right now, the 10-year Treasury is again, I think is trading low again, 2.8 something. Yeah, 2.82. 10-year Treasury is at 2.82. So if rates went to 3.82, you would lose 0.5% on the price per share of this bond fund. And so right now it's trading $8.72. I don't even know what that is. That's like 25 cents or something like that. I mean, it's not much. I don't even know if it's that. So you'd have to figure that, but it's a minimal loss. I don't even think it's 25 cents. So your price would drop down by 0.51. And that's what you want to look in terms of the risk to your bonds in an increasing interest rate environment is duration. All right. So now we have low duration. Hey, low duration, not much risk if the interest rates go up. And we have a 4.19 30-day yield. And again, I told you last time about just be careful of these 30-day yields. Make sure there wasn't a one-time interest payment that jacked this up. And I don't think there is in this case because floating rate funds are notorious for having high yields. All right, so what does that tell you? Well, that tells you two things. Not a lot of volatility if interest rates go up, and I mean, in terms of the short maturities, and it's got a significantly higher yield than average bonds. I mean, significantly higher. Short maturities with high yields. What does that tell you? There's a hell of a lot of risk here for sure. In this case, we got turnover 62% too, so there's going to be some significant tax consequence. All right, and so these are bank loans. So what they do is they loan money out to poor credit quality. That's all there is to it. Either a showroom dealer, so a dealer trying to borrow money to put cars on the lot. That's called a showroom. Is a showroom? I forgot what they call it. Floor plan is what it's called. A dealer's going to have a floor plan to show cars on the lot, and maybe his credit's not that good, so they're going to issue him essentially the equivalent of a junk bond. And this is what you're buying. You're buying these bank loans, floating rate, that have maturities that, every 60, 90, 180 days, they're redoing it. That's exactly what's going on here. And so you're thinking, okay, well, I get a high yield. I don't get much risk in terms of volatility if the interest rates go up, and they are low credit quality. I get that, but I have how many bonds are in here? I don't even know. They got 4.1 billion. I'm not sure how many actual bonds they have in this portfolio. Anyway, so there might be a couple hundred, if not 1,000 bonds in here. So what's the likelihood of me getting hammered? It doesn't say. Well, I'll show you what the likelihood of you getting hammered is. Watch this. So if you go down to the Hartford floating rate A-share bond fund, this was issued in 2005. Kaboom. Look at that. From the same thing, October. What is that right there? So October 2007 to March of 2009, that sucker was down about 40%. Let's see here. We'll show us on here the worst year. Does this shit? Morningstar, man. Which Morningstar? Yahoo's better. I should have just gone straight to Yahoo. Doesn't say the worst on here that I can see, but I know because I used to own this. It was down 40% in that time frame from 2007 to 2009. Now, the interesting thing was I had a guy come to me from Hartford. This is when I was a broker at Smith Barney, saying we have a track record of 10 years with floating rates, bank loans, essentially. Not the Hartford one, but bank loans. Never had a down year, ever. And so the insinuation was, I get it, is that it won't have a down year. So if you bought it in 2005, you're going up, and then kaboom, you lose 47% of your money. That's what happens. And why did that happen? Because the underlying credit quality of the bonds was so low, there's no market for the buy. All right. So if you had to liquidate or these are going bankrupt, the people you were lending money to couldn't pay their bills. They're going bankrupt. These banks were trying to get rid of these bonds, just offload them. They don't want to see the bankruptcy. So they're hoping to sell them for, 50 cents on the dollar, 80 cents on the dollar. And then when there's no buying, there's no buy. There's no buy side. It's all sale, no buy side. They can liquidate these things. So they went bankrupt. About half of them went bankrupt or something like that. So that is where the risk is. And I'm just telling you, I saw it with my own eyes. So this happened right there. So now watch this. $10,000 invested in 2005 is worth $16,000 today. I'm sorry, that's just not worth the risk. That's a 60% increase since 2005. Now, what if we do 10 years? Remember, we're doing some of the Vanguard funds. We did the Vanguard Income Fund 10 years ago. $10,000 invested was worth $41,000 today. No, that was at inception. Never mind. But anyway, still look at that. 10 years ago, $10,000 is invested is worth $15,000 after 10 years. You made 50% after getting hammered on $15,000. Now, we did have a little bit of drop off here. All right. And we had another drop off here. I have no clue what the future is going to hold, but I remember like it was yesterday. Oh, these bank loan funds have never lost money. 10-year track record, never lost money. They're not high credit quality. I'll never forget that guy told me that. They're not high credit quality, but they're liquid in terms of the duration. There's not much of duration, not much of an average maturity. All right, so the average maturity is 4 years. That's not bad. Duration is low, so if the interest rates go up, you're not going to get hammered, and you're getting higher yield. My friends, it's not worth the risk. And think about it like this. If I can get $1,500, if I got $100,000 in a bank account, and I can get 1.5%, that means I make $1,500 of interest. All right, it's with me so far. Now I put in this high yield bond fund, and we'll just say I get 4%. I get $4,000 of interest. I'm just saying it's 4%. So $4,000 right there. So I made $2,500 more. Now let's take out taxes. And again, these are both taxes, ordinary income. I'm just going to say, for the simplicity, 25%. You're in the between the feds and the state, you're going to lose 25%. So the 4,000 minus 25%. That means I net $3,000 on the income from this Hartford fund, and then $1,500 I net minus 25%. I net $1,125. So the question is, I made $3,000 net of taxes on the Hartford fund. I made $1,125 net of taxes on the bank, which is FDIC insured. Is it worth risking $47,000 of my portfolio? Because that's exactly what happened here. 47% was dropped to gain another $1,800 in income. I don't see, you shouldn't. I don't think so. If you're going to make that kind of risk, well, you might as well be in the stock market to at least get the upside. So let's just do another one. I don't know. I'm going to pause it real quick. Bear with me. Sorry about that. The thing kicked out on me again. So showing you have $100,000 in the Hartford floating rate fund. You grossed or netted $3,000 of interest, but you had a risk potential of $47,000 because of what happened in 2007, 8, and going into 2009. The counter to that is you had $100,000 in a high yield money market, which is FDIC insured, which has no risk to the downside, and you netted $1,125. So my question is it worth it for an extra roughly $1,800 to risk $47,000 of your principal? You cannot make that argument to me. You just can't. Now, if I want to risk the principal by 47%, well, shoot, you might as well put in the total stock market. To give you an example, the Vanguard total stock market. Now, watch this. This grew to $27,800. All right, so now we got, we're averaging, what's that? I don't even know what that is. What's $27,800? So 10,000 grew to $27,800. So let's just say 7% we're going to get. I don't know what that would be. We'll say $7,000. So now if you're going to take the risk of the floating rate fund where you're losing potentially 47% of your principal, well, hell's bells. You might as well lose 47% of your principal and get upside too. So let's just say we got 7% in the total stock index. Now remember, that's capital gains too. It's not interest. We're only going to be losing 15%. Let's see, $100,000, $7,000 minus 15%. That means we're going to net $5,950 because this capital gains are a dividend. Capital gains are long-term capital gains are taxed much, much more favorably than bank dividend, bank interest. So now I got between my three things. Let me make this bigger, easier to see. All right, here we go. All right, so here we got my three things. That is the stock. That's the total stock market index. I'm just saying 7%. And look, will that come to fruition? I got no idea. But that's just what I'm going to say, 7%. So that's $7,000 net, is we're going to say it's all long-term capital gains. So we lose 15%. We net $5,950. Here's the bank, high performance money market, which is FDIC insured. We net $1,125. And here, as you can see, this is all backwards to me. And here is the bonds, which is 4% is what's paying. Will that come to fruition? I have no idea. That's not guaranteed either. But I just say it did. It'll net you $3,000 after taxes because this is taxes ordinary income, capital gains. Be careful of safe investments. That's where I'm going with this. Be careful of safe investments. I'd much, much, much rather you just invest in the market if you want to get upside, as opposed to some safe investment that you're only going to get double your money than on a real safe investment, which is FDIC insured checking, banking, or high yield money market account. Does that help? Hope that helps. So don't forget to subscribe, my friends. Subscribe right there, and then hit the bell to be notified for future content. I'd love to have you subscribe and be notified, and then thumbs up. I'd love to hear, do you remember what it was like going through 2008? I'm telling you, man, it was scary. For the first time ever, had some bonds. I'll never forget that. 2009, I remember driving home and said, I'm throwing good money after bad. So I put all my 401k contributions into bonds. Now, there's a reason, too, I did that. I only did it for about a month because I said, I can't be in bonds. I don't like bonds. I just said at the end of the day, I had debt. I hadn't had any liquidity. I had debt and no liquidity. I said, if I get laid off or whatever, and the markets continue to fall, the money I'm accumulating in my 401k will be all the money we have to put food on the table. I just can't afford the risk there. And that's a whole different ballgame than someone who's got no debt or has got 100,000 in a checking account. That's a whole different animal. And I'll never forget that. It was like it was yesterday. I said, I can't afford the risk. And if you can't afford the risk, man, you better be careful of stocks or anything that's aggressive, because if you fall off 47% of your portfolio, that's going to be a hard hole to dig out of. That's for sure. So just be careful out there. Man, we'll see you next time. Thanks, guys.